And you're all might be prompted to accept that, so please do. All right, so let's get kicked off. And now let me introduce you to the speakers for this evening. So first we have Rodney H. Piercy. So Rodney is an esteemed estate and tax planning attorney that throughout his career, he has redirected over $300 million away from the government in various forms of taxes and directed those dollars into the pockets of his clients, their families, or their favorite charity. And tonight, we're also going to hear from David Kotler. David is a national speaker, and throughout his career, he's been an attorney and as well a business owner. He uses that experience to be able to help his clients solve complex issues and also be able to become an expert in the life insurance arena and very passionate about being able to help charitable causes. So those are going to be your speakers tonight, speaking on the various topics. So what will you learn this evening? So here is your agenda. And no, I'm not going to read it word for word, but I'm going to summarize it for you. So we're going to spend a lot of time talking about how you can convert your most highly taxed asset, which is your IRA, into a Roth IRA without having to pay the income taxes. We're going to talk about some unique strategies that we use to help prevent your estate from shrinking. We're going to cover a lot of charitable planning techniques that allow you to only disinherit the government in various forms of taxes, how you can find hidden value inside your life insurance policies and avoid them from crashing. Talk about some of the upcoming potential changes to the laws. I'm sure you hear about everything happening on Capitol Hill. Every day there's a new update, so we'll address some of those. And then lastly, the importance of having an integrated, not only legal, but financial plan and a team of advisors really working together on your behalf. So with that, for now, I'm going to turn it over to David and Rodney.
Thanks, Michelle, for a great kickoff. Just to clarify, this webinar is for educational purposes, not legal advice. The only time we can render legal advice is if we meet with you and decide it's a good fit, and then you become our client and we help you with your own unique situation. So this is general information. I'm willing, talking about our offers, I'm willing to invest time on the phone with you to see if we might be a good fit for a more thorough review of your unique situation. Then, if we conclude that it would be worthwhile, I will review your entire estate plan at no charge. I'll report on what you have and what you might want to add to update based on changes in the laws or changes in improvements, if you will, in planning, in estate planning. For example, over the last 20 years, we've added 17 protections that were either not available because of law or because we hadn't seen them go wrong and wanted to fix them. So we'd be happy to offer you that free offer. David, would talk about yours.
Yeah, thanks, Rodney. You know, what I'm offering is a complimentary life insurance review. I don't know how many of you have life insurance, and if you do, whether you get your policies reviewed at least every second year relative to their performance. There's a shocking statistic that the life insurance carriers don't want you to know, but 90% of policies do not last long enough to pay the death benefit. So the purpose of that review is to make sure that you've got the right performance, the right product. And I can tell you from experience that in one 15-minute meeting I had with one of Rodney's clients, we literally created an extra $250,000 worth of retirement income for them through the analysis that we do. The third component is to spend a little time getting an idea as to what your plans are relative to any kind of charitable planning, and from a 40,000-foot view, determine as to what might be the most appropriate next steps if that works for you. So please take advantage of these offers. They are very valuable. The IRAs that each of you own, if it's a traditional IRA, is literally your most heavily taxed asset. Why is that? Well, because not only are you paying taxes, ordinary income taxes, on what are called RMDs, or required minimum distributions, as you start taking money out of them, but there's also a heavy tax at death, an income tax, and possibly an estate tax. In addition to that, recent changes in the law have restricted distribution opportunities regarding this. So if anybody ever asks you, or just to be aware, this is your most heavily taxed assets.
So we're gonna use this opportunity, David, to do our first polling question of the evening here. So let me get this up. Okay. Oh, well, we might be having technical difficulties from the very first poll. Okay, we're gonna come back to that. All right.
I see it, if that's meaningful.
Was it the questions, or was it just showing the?
No, the questions and the answers. Yeah,
Try that again.
I have it up in front of me.
And you can answer it?
I didn't try that. No.
If anyone wants to put in the chat, is it showing you the ability to be able to hit yes or no there?
Yes, mine is showing that.
Well, but when you try to click on it, I mean, maybe.
Okay, so they said it is working. Perfect.
Okay.
All right. We'll only do the first one for now. We're just on the first polling question. So the question is, sorry, on my side, it's looking different. Question 1, do you have an IRA currently over $1 million? If you just want to answer yes or no to that question, and then we'll pull up the other ones as we go on.
So we're ready for the next slide.
Yes. Okay. All right, go ahead, David.
Okay, so we talked in the headline as to, when we were talking about the webinar, gauging your interest as to whether you would like to be able to convert the traditional IRA to a Roth. As I just said, in the last slide, the IRA, the traditional, is your most heavily taxed asset. The advantages to the Roth are that there are no RMDs. There are no inheritance taxes on them. And this is a big one. There are no income limits when you convert a Roth versus contributing to a Roth. So the point is, if you have a large IRA and you want to be able to convert it to a Roth, you're not going to be limited because of the size. What are the disadvantages? Well, that you do have to pay a tax. What we're going to show you is how to mitigate or how to avoid paying that tax, which is really just through the creative use of charitable trust, which we're going to talk in a second about. The bottom line is, sometimes you may have seen ads on TV. Would you rather be taxed never or forever? And that's sort of like the Roth versus a traditional IRA. What's the next? Oh, we have another polling question at this point?
So on the polling questions, so for some reason, they're all launching together. So we're going to do all of them at the end after we've covered all of the topics so that you can answer the questions then.
Great.
Okay. So no tax. That sounds pretty good, doesn't it? How do we get to no tax? Well, the government, in their infinite wisdom, back in, I think it was 1964, Rodney, or 64, created, legislated charitable trusts. And through the creative use of charitable trusts, large tax deductions can be enjoyed. And what we're going to talk about in this webinar, amongst other things, is how you can utilize that charitable deduction that you created through donating or utilizing a charitable trust to offset the tax that you would ordinarily have to pay to convert your IRA to a Roth. So I think without further ado, let's go to the next slide.
So I think we all would have converted our traditional IRAs to Roth if it weren't for having to write a big check to the government for doing so. And so when you eliminate that negative, there are no other negatives with, so there are really two kinds of charitable trusts. The charitable remainder trust, which is a critical element for a Roth conversion, and a charitable lead trust. Now, you're not supposed to know anything about these, and surprisingly, a lot of accountants don't know very much about them either. But a charitable remainder trust is exactly what it says. The charity gets the remainder. A charitable lead trust is exactly what it says. The charity gets the lead interest. So what are we talking about, the remainder and the lead interest? Well, a charitable remainder trust, you basically put assets into a basket. It's an irrevocable trust basket. You can't get the money back the next year to go buy a villa in Nice, but you do get two really huge benefits. Well, more, but two biggest ones are you get a tax deduction when you put it in for the imputed value when it goes to charity down the road. So it's not a dollar for dollar. So you get a big deduction, and that's what we use to convert the Roth. But you also get an income stream you cannot outlive. If you live to be 130, you're still getting a payment from that charitable remainder trust. And it is also lawsuit proof and not in your estate tax. So those are the main advantages of a CRT. A lead trust is the exact opposite. You basically put money into an irrevocable bucket, which pays income to a charity for anywhere from 12 to 20 years. And when it's at the end of the term, you can either have the money back that's still in the bucket, or you can have it go to your kids without estate tax. So those are the two kinds. Let's look a little closer at a charitable remainder trust. I like diagrams. They help me understand things. So basically, you're the donor. You donate or gift, transfer, deed in the case of real estate, property into this basket. What do you get back? You get payments during your lifetime. And when you and your wife pass away, the charity gets what's left. What's really neat is that if you're doing a Roth conversion and you want a big deduction, you probably take the smaller payment, so the charity is supposed to get more when you both die. We'll talk about replacing that wealth in a minute. But so you could also say, I don't like charity. I don't really need that much of a deduction. I've got a small a small traditional IRA. So maybe you take the most out you could take out for your lifetime, which could be as high as 10, 12% a year. And of course, if you take out 12% a year and it only grows at 8, the payment will get a little smaller. But again, you can never outlive it. So this is a really, really powerful tool. And as David said, these have been around for almost 60 years. I've done hundreds of them, but it's only recently, basically, that David and Michelle have helped me see that the combination of this with a Roth conversion as being a really powerful thing that many, many people want to take advantage of. So I'm going to do a little quick case study. This is a case that we worked on last year, and we had a client and his wife who had about 20.5 million of taxable estate projected when they died, and they were looking at a huge, $5.6 million estate tax, leaving only about 14.9 million for their family. That was before we did the Roth conversion. When we did the Roth conversion, the family got 7.3 more million for their loved ones. And yes, part of that was insurance, because basically the CRT funded the insurance with increased income, and the deduction was used to convert the IRA to a Roth. So I ended up with 5.9 million less in taxes. We kind of like it when the government basically pays for your kids' inheritance with some of these benefits. A lady asked me today, is that a loophole? The answer is no, but it used to be that charity was a good thing. Now in the IRS and in Washington, the winds are blowing a little bit in the other direction. They're trying to find ways to shorten and cut out some of these. They're looking twice at Roths, and they're trying to pass. In the last few tax proposals that didn't get passed, they were looking at definitely impacting Roth conversions. And so as far as law changes, these things that we're talking about tonight are available now. Whether they'll be available down the road, we cannot say, but we do know one thing: government is spending more and more money, and so they got to get it from somewhere. And they don't like charitable tools because it ends up with less money going to them. Michelle, did you want to talk about an actual client that we
Yes.
worked on?
So yes, so the case that Rodney was just describing there, we actually got a testimonial from those clients, and this is what they had to say, that they'd completed their process and they're very happy with the outcome, and to say that it made a great change in all aspects of the trust that they had currently, and then the planning that they did. And their final word there, that if it helps, that their words and they're going through the process, hopes that it helps the next person listening to sit down and have a conversation to see if this is also the right type of process for them.
We also, my last case study was the charitable lead trust. And again, the only reason we're talking about this tonight is not that you need it for the Roth conversion, which is what this whole seminar is about, webinar, but it's because you might be sitting there either this year or next with a huge spike in your income. And you're saying, well, I didn't have anything to do with that. I couldn't stop it, but I got it. Now I got to pay tax. So we had a young lady and her husband. She worked at a tech startup in California. You may remember California has the highest taxes in the world. And so she worked at this tech company, and she had some stock options. And all of a sudden she got an email saying, we sold the company. Congratulations, you're getting $3 million. Now, that would be wonderful news, except about half of that with state and federal taxes was going to go to the government. And so she was interested in carving out some without any tax on it and putting it in a charitable lead trust. Well, actually, there would have been tax on it, but she got a deduction equal to the $1 million she put in it. So that at the end of it all, they ended up with about 500,000 more to enjoy over their lifetime. They wanted, since they're so young, they wanted the money to come back to them, not through an irrevocable trust to the kids without an estate tax. So they were also very happy. So what kind of a legacy would you like to leave? Would you like to leave a legacy of being wise and giving more to family and loved ones at the same time as giving more to charity, or basically just paying a lot of taxes? And that's what we do. And I've actually just kind of why I'm here tonight is because in 1993 I started out as a commercial industrial development real estate attorney. I was doing big deals, multi-million dollar deals. I was having fun, but I didn't really feel that what I was doing had any great significance. And so I discovered estate planning, and I realized very soon, within the first few months, that I could really make a huge impact here with disabled children, problem children, getting rid of huge shrinkage at death with trusts versus wills. And we're not going to cover that tonight, but if you're a client of mine and if you haven't had your estate plan looked at in the last 6-7 years, I encourage you to give me a call. I normally charge $450 to review a plan because I have to pull it all out and then spend an hour with you. But as part of this, we're offering that at no charge because you're also potentially a candidate for some of these other things that are definitely dovetailed. So then a few years after that, I discovered tax elimination planning. And I got to tell you, I can't think of any better reason to get up every morning than to be able to redirect money away from the government to family and charities and make a really multi-generational impact. So as Michelle said, we've been able to help a lot of people move a whole lot of money into better places. Planning is bringing the future into the present so you can do something about it now. And that's what we do. And I'd like to tell you a little bit more about David, how I got to know and work with David. I met David almost 10 years ago at a conference of high-level planners, national conference. And I was having a coffee break with him, and I realized instantly that this was different than any other insurance professional I've ever worked with. Because he just doesn't want to just sell life insurance. He wants to fix things that are broken, make things healthier in policies. And so I've worked with him probably with 20 clients, and we've literally avoided some really, really huge disasters. For example, I had a client who bought a policy in 2000, and the agent told him that you're moving money from another policy into this. You're putting several million in. You never have to pay another premium for the rest of your life. And so by 2015, he started getting this feeling in the pit of his stomach that something didn't seem right about it. So he called me up and I called David up, and we looked at the policy, and lo and behold, the company that had been in the top 13% of all companies back in 2000 was now in the bottom 37%. And the policy was going to basically crash, run out of money in 4 years. This guy at the time had a life expectancy of 12 years, and he was going to owe $1 million in taxes. So that took us about 4 months to work with, to get that policy replaced, get it out of there, and not pay a huge tax at all. That's just one example. I had another client with a very, very large policy, and he's basically, I think it was a $10 million policy. And he basically said, I really don't want to be paying these premiums anymore. And I have been, and it was a good thing. It was 10 million for my heirs, but is there any way you can, so I don't have to write a check every year? It wasn't that much of a check, but it just bugged him. So we put David on it, and pretty soon we had someone else take over the premiums completely. This guy's life expectancy is again like 10 or 11 years. Someone else is paying the premiums, and he still gets a $5 million death benefit, and he got all of his money back that he put in the first place. So to me, it's really about bringing the right specialists into my team. David?
Thank you, Rodney. Thank you very much for those kind words. And I just want to reiterate, I know I've told you many times, but it's been a pleasure working with you over the years. You're a true professional. You care about your clients. And it makes it that much more fun when you can solve problems. As Michelle said at the beginning of the show, that's really one of my favorite things to do, is to take something that seems to be a huge problem and turn the lemon into lemonade. Just a side note, it just happened. I'm so happy for it. But I have some clients I've had for 25 years, and they had a large problem with some of their life insurance. And it could have been subject because of the way it had been structured, where if they couldn't solve the problem, they were looking at having to pay $3 or $4 million in income taxes. And, by having a lot of resources around the country in various ways, we're actually able, in a very legal, reportable way, to make those taxes disappear and create some death benefit for their families. So it's a lot of fun doing that. But how did I get into this? Let's take a look at the next slide. My passion is in the life insurance and the charitable planning arena. I think most people, when they end up doing something in life, there's a reason why they got very focused on something. I had always wanted to be an attorney growing up. When it came time to go to law school, I said to my dad, I wanted to go to law school. And he says, well, I can't afford to send you there, but if you want a job working here, you could put yourself through school at night. And I said, that's a great idea. And so over a 5-year period, I got my law degree, but I decided to stay in the business, and the business grew quite significantly. We had a very good attorney look at our stuff, but nobody had ever spoken to us about how important life insurance is, especially in a business setting, and especially where you have siblings. Some are in the business, some are not in the business. You're involved with banks, and the need for liquidity. That's the biggest need. And that is one of the larger benefits from life insurance. The bottom line was, after 20 some years of being in that business, when my dad passed away, because we had no insurance and all the financial pressures from all the various sources, I lost that business. And so when I had to reinvent myself in terms of what my career was going to be, I had been very philanthropic as the business was successful. So it became my goal to try to blend the use of life insurance along with charitable or philanthropic planning. And that's really my mission and my passion. Let's take another look at life insurance. Why is it so important, planning? We've said liquidity, but there's, you take a look at the markets today, you take a look at the world today. The one thing about life insurance is that it is a safe and a certain result, so long as the policy is going to perform. And just like with the charitable trust we spoke about that offer significant tax advantages, life insurance also, because of really how it started as protection back in the 17 and 1800s for families that had farms. They were illiquid, and the government realized how important it was to have this type of product available. And so life insurance still enjoys those types of tax advantages. The other fascinating thing about it is that we use the word leverage. There's a way to magnify the results through smart planning and financing in some instances to even augment the really good basic benefits you get from life insurance. So the mission is to help business owners and high net worth families avoid losses. We talked about the importance of life insurance, but just as important is this idea of having an integrated plan. In my instance, we didn't have an integrated plan. I think when we look at some of the problems, when we review client situations, it's always a problem when things are not integrated, when the left hand doesn't know what the right hand is doing. And with insurance, as mentioned before, and I've got a book that you could download for free on my website, lifeinsurancedr.com. But the amazing statistic that 90% of policies lapse and don't pay a death benefit. And that bothers the heck out of me. I don't know, I'm sure probably all of you were brought up not to waste. To me, that's a huge waste. A waste of premiums, a waste of hopes and dreams and wishes that people were counting on those proceeds that aren't going to get them if they don't do a regular review of performance. What does a policy performance review look like? Usually you're going to get one of three outcomes. Sometimes good news, your policy's in great shape. And even though it's in great shape, I believe that the fact that we've analyzed it and gone through it is of great value, because you have at least the certainty and the confidence to know that you're on the right track with what you have. It's got a value in and of itself. Many times the policy needs work, or it just doesn't provide as broad a basket of benefits because maybe it's an older policy. today, since for example, the cost of long-term care has gone up so significantly, there are very few companies even offering it as a standalone product. But what's happened, because a good thing about the insurance industry is that it's very innovative, and they're always looking to how they can tailor their products to provide benefits for a greater percentage of people. And so that's one example of where if you have an older policy without a long-term care component and you're in good health, it's certainly worth looking at, because I think 35 or 40% of individuals can expect to have some type of long-term care event. The last box is very interesting. Maybe some of you have seen some of these ads you see on TV. Hey, if you don't need your policy, you could sell it. And then they show you a picture of people enjoying all their proceeds, and they can take care of their medical expenses, or they can go on a trip or do whatever the heck they want to do with it. It happens to be true. This is a business that's come about in the last 25 years. Rodney mentioned a couple of situations where we had what they're called life settlements. And what that basically means is people like Warren Buffett or large pension funds recognize the significant value of life insurance, even though you personally either may not be able to afford it, or you feel that you don't need it anymore. The purpose for which you bought it doesn't exist. Your children are very successful, or you don't have a business anymore, but you have this policy. Before you think about throwing it away, and this includes term policies, by the way, in certain circumstances, term policies can be very valuable. And those don't have any cash in them, but they have value to these large buyers, again, like Warren Buffett or pension funds or a lot of other companies. It's a $25 billion business. And I can tell you that have saved literally over 100, provided cash benefits and tax savings and policy premium savings of well over $100 million. So this is something, if you're 75 or older, or you've had a change in health, you really should explore this option, just to know what you could do if you're considering doing that.
So David, his website has DR in it. I want you to know what the DR means. It means doctor, and I gave him that name. He's the life insurance doctor, because he can take his stethoscope and feel the pulse and do a full medical exam on a policy, and without any cost, which is a great value. Anyway, so we have talked tonight about charitable planning, tax planning, insurance planning, lots of different things. And these are very complex areas. So it's important that you work with people who are very specialized, very lots of experience. What we've done is realize the importance of integrating all these professionals into one team. And you probably know that a football team that is a real team and does everything as a team will just annihilate a team where there's a bunch of superstars trying to make themselves look good. So we have built attorneys, investment experts, CPAs to work together, every one of whom we have identified, qualified, and worked with. And no one is on our team that isn't a team player. Did you want to say a little more about that, David?
Well, I think that, as you said, the lack of coordination it can be a fatal flaw. And so we recognize the importance of that. And we've done our best to identify other professionals. None of this is mandatory. It's an option if you don't have somebody in that space. For example, we work with what they call a third-party administrator. That's a very complex type of accounting used primarily for charitable trusts. With charitable trusts, there's literally 4 levels of different tax treatment for the monies that are coming off the charitable trusts. And our team just last year was involved in the creation of 125 charitable trusts. So we're very familiar with this area. We've got very good expertise in all different aspects of it. And we're here to help, whatever we can do to help you realize your dreams and your goals and maximize the benefits for your family and for charity.
So speaking of that fully integrated plan, everyone working together, one of the individuals who attended our last webinar gave us these remarks. He said that the webinar was very educational and interesting. So he decided to reach out to us as a follow-up and discuss his current situation. Everyone that he worked with was excellent and works very uniformly, and that they're all experts in their respective fields. So we appreciated his words there. So that is really the end of the informational portion of what we wanted to share tonight. What I'm going to do at this point in time is launch up the polling questions so that we do get those. And then then we'll open it up for questions. So I am going to, because I know some of you went in and completed them, but I don't think everyone had the opportunity. So we're going to launch this again. So if you did already answer, go ahead and answer again if you will, please. That way it gives everyone the shot. Because what I realized, someone told me in the chat, unless you answered all 6 questions, it wouldn't submit them. Right. Let me get a check here. There we go. We've got some answers coming in. So just kind of running through them as they would have been in order. When we talked about the IRA to kick it off, you know, the polling question is, do you currently have an IRA worth over $1 million? And we kind of came up with that $1 million number based off, you know, knowing what the projections of the RMDs will look like and what future tax on liability will be on that there will likely still be a large amount of that IRA left that'll be taxable to your heirs. The second question there is, have you been considering a Roth conversion? And it looks like a lot of you had been, but you didn't want to pay the taxes, which is the most common answer that we get. The third questions, were you aware of all the different tax benefits of charitable planning? It looks like a lot of you were not, and some of you were, but not to the level that they can be. So just to speak on that topic a little bit, it's really the integration of all of the different concepts, which makes those tax savings so robust. It's the combination of the charitable using the plan, using the tax deduction to offset the Roth, eliminating the future taxes where it's just a compounding positive effect.
And utilizing the government's dollars to purchase insurance to replace the asset that was donated.
Absolutely. It looks like almost all of you are spending, you know, around $10,000 or less a year on your insurance, which is a significant investment to make sure those policies are getting reviewed. And then perfect. So the last one there, you know, is just letting us know what you thought. You know, a lot of you saying that it's very educational. So let's open it up for questions now. So I've got 2 questions here in the chat. Actually 3 questions. So the first one to kick off, because it came in first. So David, I'm going to address this to you, but Rodney, you can chime in as well, is that, you know, my understanding is that life insurance is most needed when you have dependents. As all of my children are grown with full-time jobs and our home is paid off, why would life insurance be a necessity?
I don't think that life insurance is, I mean, is it a necessity? Yes, it's a necessity if you're young and you're married and you got children, even if it's term insurance, you know, you don't, I've just seen it so many times and we hate to see it, where families are left bereft, or you've got business and you've got different things. So is there a necessity? If you don't have any dependents that need it, I suppose there could be reasons why it might make sense, You might be utilizing it to help augment your retirement income, for example. You might be utilizing it to augment a charitable gift. You might be using it if you have grown children, perhaps you have grandchildren or even great-grandchildren. So it's not that it's a necessity in that instance, but there could still be good reasons why you might want to consider it.
Okay, so two questions then on the charitable side. Can you go through the first charitable trust example again? So the charitable remainder trust.
Sure. Basically, and we don't have to go to the slide, basically, you put money into an irrevocable trust or a highly appreciated building or Apple stock that you paid $10 for, and you put it in, and then it can be sold without a capital gains tax. So that's wonderful. But in addition to that, you're going to get a tax deduction this year for somewhere between 30 to 60% of the value of that you can use to shelter a Roth conversion. Now, but you want to know more about the CRT. Okay, so for the rest of your life, either quarterly, monthly, or annually, you're getting a check. And some of that will be, a small amount of that will be ordinary income. Some of it will be capital gains tax to you. Some will be a return of principal. It all depends on the performance inside the CRT, which is invested. Financial planners don't mind CRTs at all because the money is still with them, not going to Washington or Springfield. So they love it. So you're basically trading an asset for an income stream. Every year for the rest of your life, you're getting a check. You're also getting deductions that you can use to convert your IRA to a Roth, which means you don't have any RMDs. And when the kids get it 10 years later, it's all tax-free. So if that doesn't answer your question, please call me because I can spend more time with you. You know, I saw one question, when are we going to learn about how to convert a Roth to a Roth in terms we can understand? And I know the gentleman, and you know, we cannot go into all the details with all the flow charts and all the numbers because it's so unique. It's based on your age. It's based on how much you want to take out. So the purpose of this webinar was to just say, do you have big IRA? Would you like to know how to do it without, convert it without a tax? Call us or fill in. There's actually a place for you to click on a box and schedule a call with either David or me. So that's where we get into the stuff about you. This is just a big general thing to make you aware of your opportunities.
Yes, so I did put those links in the chat so that if you want to copy and paste that, you can go to have it, but you can also click directly on it and schedule. So another question in regards to the CRT, do I choose my CRT investment portfolio?
The answer is absolutely yes, unless you don't feel competent in doing investments, in which case your financial advisor can continue to invest those after you put it in. So the answer is you control either directly or through your advisors every single investment decision in the CRT. Now, there are a few things you can't do in a CRT, like go to Vegas and put it all in slot number 4 in the roulette wheel. That's called a jeopardizing investment. That would violate the law, jeopardize the whole thing. So you got to, you know, prudent man, diversification. There are rules about investing, but you wouldn't want to violate those rules anyway.
So another question, David, if I have a term policy, why would I want additional life insurance?
David, let me take a shot at that. I know the person who asked it, and you're going to get a chance, but I just want to start out by saying, everybody who's working and has family needs a term policy to replace their income when they die. And a rule of thumb is 10 times earnings. I'm not an insurance pro, so I don't know if that's a good rule or not. Everybody needs a term policy. But your question is, why would you need more than that? Well, if you were doing $5 million CRT or even $1 million CRT, and you didn't like the idea when you died of maybe that million going to charity, and you wanted to get more deduction to be able to shelter a bigger Roth conversion, you want more to go to family, you might buy a whole life policy with 3%, 2 or 3% a year premium, maybe even 1.5% a year, to replace the wealth that's going to go to the charity when you both die. So wealth, we call it wealth replacement insurance, and it has to be whole life. It has to have strong guarantees. But yeah, the policies that I've worked with in this area have been because people didn't really want that much to go to charity. They wanted more to go to family. So they wanted to replace the wealth. David, you can add to that.
I'm gonna, those are very good, complex answers. I'm gonna answer it in a very simple way. They call it term insurance for a purpose, for a reason, right? It's only good for a certain term. So the reason why you might want permanent insurance are too numerous to go into, and we go way past our webinar time if I try to list all those. But term insurance is for a specific term. When you're young and you want to cover your income for your family, that's a great choice. You got a building, the bank is financing, and the bank says you got to have insurance in case something happens to you. That's term insurance. But permanent insurance provides a permanent benefit. Something like 99.96% of term policies don't pay the death benefit because they're established for a certain term. So those are hopefully some of the simple reasons why you might want permanent insurance.
So a question back with the CRT, what percent of the CRT has to go to charity?
Great question. A minimum of 5% a year. And as long as you do better than that in your investments, your payment will go up. If you have a year when it's negative 5%, your payment will go down a little bit.
Rodney,
Minimum is 5%.
I'm sorry.
5%. Every January 1, it's recalculated, but 5% is the minimum of a CRT, not a class.
Well,
I'm sorry. I thought the question was how much had to be left in the CRT at the end of it for the
Correct.
gift to charity, and that is
the answer is 10%.
10%.
And that's not necessarily 10% what do you put in and now, but what it does is it takes your age, the federal life expectancy tables, and it calculates with the projected government growth rates. It projects how much will be there when you die. It can't be less than 10%. And by the way, you can change the charities during the term anytime you want, even though it's an irrevocable trust.
I think just to sort of clarify what Rodney was addressing when he said the minimum of 5%, what he was referring to was the income stream that he discussed when we promised to you if you establish a CRT. And that range can be anywhere from 5, I think, even as high as 15% in some instances.
Yeah,
right?
you get an older person, it could be 20%.
I mean, yeah, so it's just that the government wants you to be distributing some of it for yourself. Those monies are going for you. And the 10% minimum is what's got to be left at the end of the day for the charity.
Thanks for clarifying. I didn't hear that.
Okay, so another question on the CRT. I think it's to provide a little more clarification. You said, when you're saying you should use highly appreciated assets to put into the CRT, why are you saying that with the tax savings on the donation that for converting the Roth? So I think maybe make a clear distinction between the capital gains savings and the income tax.
Sure. So a CRT works with cash, which of course is not appreciated. Actually, it's depreciated, but it works with cash. But it works better if you have an asset that has grown in value and you really don't want to sell it, but you don't want to pay capital gains tax, because now you're getting two benefits. One, you're getting a deduction, but two, you're getting a cash tax, capital gains tax-free sale and repositioning, re-diversifying. So it's not necessary to have the highly appreciated asset. But I was talking to a lady today that has highly appreciated stocks that she would diversify if she didn't have to pay gains tax on it. So now she could diversify it by using that to get the Roth conversion done. Does that answer that?
Yeah, I think just one more point, I think, and that's an excellent answer, Rodney, is that bear in mind, when you put an asset into a charitable trust, it's now inside a protective entity, this charitable trust, that doesn't pay taxes. And that's why when you put an asset in there, which is appreciated, and the charitable trust sells that appreciated asset, that charitable trust will not be taxed because it's a charitable trust. So it is, as Rodney said, it's a side benefit, it's a dual benefit, but it's a very large benefit, which is just unique to the use of charitable trusts, charitable remainder trusts.
So Rodney, I'm going to direct this question towards you that I am sure you were never asked when you started your career. This would be a very 2022 question. Can a CRT be part of a crypto wallet?
Boy, you know what? That is a great question. And the answer is, I believe so, but I'm not sure. So if someone who asked that question would email me that question or somehow let me know, maybe on a 15-minute call, I will get that answer for them very, very quickly. I would imagine so, but I'm not gonna never rely on a guess. It's my rule.
Right. David, so someone said they have, several fully paid up whole life policies for one of the big mutual companies, all with the cash surrender value and death benefit. Should these types of policies be reviewed?
Absolutely. Absolutely. Every policy should be looked at. Again, the worst that's going to happen is that everything's in great shape. But what if we look at it and you find out that for no more money, you can increase your death benefit by 50%? Would that be a worthwhile 15 minutes? Or conversely, what if we look at it and we find out that lo and behold, your agent said, hey, you can stop paying the premiums. They're going to disappear. Usually what disappears at that point are the agents, because the premiums never disappear. The company may be borrowing money from your cash to pay the premiums, and all of a sudden you find out you've got a loan on that policy. And I won't spend a lot of time, but I can tell you one of the worst results are policies that have loans, and these policies go underwater. Not only is the insurance loss, but the insurance company will send a 1099 reporting an unpaid loan, which is debt forgiveness, which translates to ordinary income taxes for you. So absolutely, every type of policy should be checked. It's probably a very conservative, very good situation, but sometimes they can be improved. So yeah, I highly encourage you to spend the 15 minutes, sign up for a meeting.
So with the next question that came in, I think we want to add a little clarification on the process with the CRT. The question is the IRA converted to the Roth prior to putting it into the CRT? If so, are the tax consequences offset?
Well, you don't actually put the IRA into the CRT. That's why in our invitation, we said you qualify for this kind of thing if you have both a traditional IRA and some non-qualified money, because it's the non-qualified money that we put into the CRT. And then the IRA goes from a traditional straight into a Roth. And you do it in the same tax year. That's the only requirement. It doesn't have to be one before the other, but yeah, they are done in the same tax year as part of the part of the same transaction.
Yeah, so that kind of speaks to those highly appreciated assets. It's those highly appreciated non-qualified assets that go into the CRT.
Right.
That
Or not highly appreciated. I mean, what I'm doing is I'm saying, okay, you decide you want to do a CRT, you want to put 2 million in it. So you can do 2 million worth of conversion of other, so you want to put 2 million in it. So what are you going to pick? Well, let's start with the assets you have that have the most appreciation, just because then there's no gains tax. So it's not a requirement that we have highly appreciated assets, but it's nice to get rid of gains that you otherwise would have.
yes. So the question is will the recording for the presentation be available for review? And the answer is yes. After this ending, we will have the recording and we will send it out to all the attendees.
I think it'll also be on the landing page that you signed up for the webinar with, and probably it'll find its way to both Rodney's website and my website as well.
That might take a while though.
Yep.
And that, well, got one more. Can we have both a CRT and a revocable trust?
Absolutely. Everybody needs a revocable trust to avoid probate. And the purpose of that is to take whatever the tax-free amount that you want to get to your loved ones and get it to them without a 2-year root canal, which is a probate case. So that's, everybody needs that for their, what I call basic estate planning. But in addition, you need a CRT if you want to do a Roth conversion without a tax, or you want to sell highly appreciated assets without having a gains tax paid.
Yes, we'll just share one client that we were referred to that Rodney worked with. They had 19 trusts. So not that we're recommending 19, but you can have very many. All right, that seems to be all of the questions. If anyone wants to sneak any last questions in, and it's perfect timing because we're 2 minutes before the end of the hour. So I will just remind everyone, I'll put the Calendly links back into the chat, that if you want to talk more on a personalized basis about your particular situation, if it's in regards to legal documents, schedule that conversation with Rodney. If it's in regards to you would like to review your life insurance policies, schedule time with David. Or if you just want to sit down and kind of talk more detail about planning and charitable planning, you can schedule that with either David or Rodney, and we can have that joint meeting together. All right, David, Rodney, anything else to close with?
Well, I want to thank everyone for attending. I think that as the laws become more complex and taxes keep going up, it's a good idea to keep your finger on the pulse, so to speak, and keep an eye on what's going on with your tax situation.
I again thank everybody also, and thank you, Michelle, and thank you, Rodney, for helping make it such a great webinar.
All right, everyone, enjoy the rest of your evening, and hopefully we will talk soon.